Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing CINTAS' stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 51 billion market cap. They're trading at $5.04 a share, and they have 101 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do generate a healthy and consistent amount of free cash flow. It's 1.1 billion in 2020, then 1.3 billion in 2023. They just completed their 2023 fiscal year. Their fiscal year ends May 31st. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that goes up each year from 876 million to over 1.3 billion. Revenue is the sales for the company, and that goes up steadily from 7.1 billion to 8.8 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 44 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $39 billion. We divide that by 101 million shares. And we get a calculated stock price of $386. They're trading at $5.04, so they're trading at a 31% premium. It's a strong sell according to the model. You may be wondering why their stock price is so high, over 500. Probably because they never split. There are 37 companies in the same industry as CINTAS, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 300 million. The average is 100 million, the median is 27 million. These are investments in property, plant, and equipment. That includes the cost of a factory to manufacture its products, or the cost of machinery to make its products. Their debt-to-equity ratio is equal to the median, 0.8. For every dollar of equity, they have 80 cents of debt. Their dividend is a little higher than the average, lower than the median. They pay a 0.9% dividend. They generate 1.3 billion of free cash flow, a lot higher than the median average. Of the 37 companies, they rank third in market cap. Relics is first at 64 billion, Thomson Reuters 61 billion, then this company 51 billion. Their price multiples are worse than the median in every category. So if you were the type of investor that just looked at price multiples, the stock would appear overvalued. They generate a lot more revenue than the median average, but as a percent of their market cap, their price to sales is 5.8. So they generate more revenue than the average, less than the median. And they are growing. Their 5-year annual revenue growth rate is 6%. The median is only 4%. Look at global payments, 19%. And their revenue is a little higher than CINTAS. So it looks like GPN should be moving up pretty soon. Maybe I should do a video on this company. Just the other day, they released their fourth quarter earnings. And their fourth quarter ends May 31st. So their fiscal 2023 is June 1st, 2022 through May 31st, 2023. They beat analyst estimates for earnings and revenue this quarter and the last 3 quarters. Let's take a look at their 2023 press release. They completed their 2023 fiscal year. So this report shows us fiscal 2023 fourth quarter and full year results. For the full year, revenue of 8.8 billion, an increase of 12% over 2022. Operating margin 13.6%. EPS of $13, up 11.5%. Fourth quarter revenue 2.28 billion compared to 2.07 billion. That's an increase of 10.1%. Gross profit of 1.1 billion compared to 946 million. That's an increase of 15%. They have really high gross margins, 48%. Last year was 45.6%. And the reason their gross profits were higher is because energy expenses, gas, natural gas, and electricity were down 65 basis points, or 0.65%. Fourth quarter operating income 471 million compared to 404 million, an increase of 16%. So their operating margin 21% compared to 19.5%. Net income was 346 million compared to 294 million. And fourth quarter EPS 333 compared to 281. That's an increase of 18.5%. And they've increased their dividend as well. They paid out $118 million to shareholders, an increase of 20.6%. That's just one quarter of dividend payments, $118 million. For 2024, they expect revenue to be $9.35 billion to $9.5 billion. And EPS forecast $13.85 to $14.35. Their interest expense forecast is $98 million to $110 million. CINTAS helps more than 1 million businesses of all sizes and types to open their doors with confidence every day by providing products and services that keep their customers' facilities and employees clean, safe, and looking their best. They offer uniforms, mats, mops, restroom supplies, first aid and safety products, fire extinguishers and testing, and safety training. Let's take a look at their fourth quarter income statement. Revenue of $1.8 billion, up from $1.6 billion, up 8.8%. That's only their revenue for uniform rental and facility services. Other revenue $500 million, up 15%. Total revenue $2.3 billion, up from $2.1 billion, up 10%. Let's look at their expenses. The cost of uniform rental and facility services $926 million, up 5%. Cost of other $269 million, up 11%. Selling and administrative expenses $618 million, that's up 14%. So their operating income is up from $404 million to $471 million, up 16%. So their margins are improving quite a bit. They pay $26 million of interest on their debt, up 12% from last year. Income before taxes $446 million. Income taxes $100 million. Net income $346 million, up 18%. EPS of $3.39, also up 18%. And they have less shares outstanding. Last year they had 102 million. Now they have 101.8 million. For all of 2023, their revenue is $8.8 billion, up from $7.9 billion, up 12%. Operating income of $1.8 billion, up 14%. Net income of $1.3 billion, up 9%. They have the highest gross margins in uniform rental and facility services, 47.7% compared to last year of 45.7%. Other gross margin, that was 47.4% compared to 45.4%. First aid and safety services is a bulk of the other revenue. Let's look at their balance sheet. Their current assets of $2.9 billion, current liabilities of $1.2 billion. So their current ratio is above 2. They can easily cover their current liabilities with their current assets. They have $124 million of cash on their balance sheet, up from $90 million from last year. Lots of accounts receivable is $1.2 billion. That is up from last year of $1 billion. $500 million of inventory, $1 billion of uniforms, PP&E $1.4 billion, up from $1.3 billion. They have lots of goodwill, $3 billion. That's their biggest asset. So they do lots of acquisitions. Total assets $8.5 billion, up from $8.1 billion. They have $3.5 billion of liabilities, a little higher than last year. Their main liability is long-term debt, $2.5 billion. Let's look at their equity section. This could give us an idea of how profitable the company is. They raised $2 billion from selling their business, from selling stock. They profited $9.5 billion from running their business. And they bought back $7.8 billion of their own stock. So it looks like a pretty healthy company. Let's look at a statement of cash flows. They generated $1.6 billion of operating cash flows because net income is your accounting profit or loss. That was $1.3 billion. Net income is not actual cash. The actual cash they generated was $1.6 billion. Because there's lots of non-cash items on the income statement, $250 million of depreciation, $150 million of amortization, $100 million of stock-based compensation. Let's look at their investing section on the statement of cash flows. They spent $330 million of CapEx, $46 million of acquisitions, so they had a cash outflow of $388 million. In their financing section, they paid $449 million of dividends. They bought back $400 million of stock, so they had an outflow of $1.2 billion in their financing section. It looks like they did do a bunch of stock splits. The last one was in 2000, 23 years ago, a 3-for-2. In 97, a 2-for-1. In 92, a 2-for-1. And in 91, a 3-for-2. If you invested $10,000 into this company 10 years ago, you'd be really happy at $120,000 today. That's an 1100% total return, a 28% annual return. Let's take a look at the company on Simply Wall Street, trading at 504, 50 billion market cap, up 33% in the past year. Let's learn a little more about the company. CINTAS provides corporate identity uniforms and related business services, mainly in the US, Canada, and Latin America. It operates through uniform rental and facility services, first aid and safety services, and all other segments. The company rents and services uniforms and other garments, including flame-resistant clothing, mats, mops, and shop towels, as well as other ancillary items. They also provide restroom cleaning services and supplies, as well as uniforms. They offer first aid and safety services and fire protection products and services. They provide products and services through its distribution network and local delivery routes, or local representatives to small service and manufacturing companies, as well as major corporations. Founded in 1968, headquarters Cincinnati, Ohio. It looks like they started trading in 1990. The stock went up 1,000% from 1990 to 1999. If you bought it for $50 in 1999, after 10 years, you'd be down over 50%. You'd have to wait several more years to get back up to $50. It looks like in 2013. So you would have had to wait 14 years to get back up to your cost basis. Then it ran up a lot from 2014 to 2020. It hit almost $300. Then COVID hit and the stock came down to under 200. Ever since April 2020, the stock has pretty much only gone up. They're currently trading at the highest point ever, above $500. In the past 5 years, the stock is up 145%, its industry 71%, the market 50%. They've outperformed their industry and the market the past 3 years, 1 year, and 90 days. Simply Wall Street's valuation is $392. They're trading at $504, so they say the stock is 29% overvalued. This is the first time I'm looking at Simply Wall Street's stock price, and it's really close to mine, which is not too common. 15 analysts priced this stock, and the average price target is $517. They say the stock is 3% undervalued. In 2012, their trailing 12-month revenue was $4.1 billion. Their revenue increased little by little over the next 5 years, breaking through $5 billion in 2017. Then it grew a lot more, breaking through $7 billion in 2020. It dipped a little during COVID, falling below $7 billion, but it has grown a ton since 2021. Their trailing 12-month revenue is close to $9 billion. The forecast is for them to break $10 billion by 2025, getting close to $11 billion by 2026. Their debt always seems to be fairly close to their equity. In 2012, $1.3 billion of debt, $2.1 billion of equity. So their debt to equity ratio was 61%. Then by 2017, their debt was $3.1 billion, equity $2.3 billion, debt to equity of 136%. Since that point, their debt has come down but remained fairly steady, while their equity increased quite a bit since that point. Now their equity is $3.9 billion, debt of $2.5 billion, 64% debt to equity ratio. 0.9% dividend, the industry average is 1.3. They pay out 35% of their earnings in dividends. Their earnings are $13.25 per share. They pay out $4.60 in dividends. You can see they raise their dividend each year. They were paying 54 cents a share in 2012, and every single year they raise it. They're currently at $4.60 per share, and the forecast is for them to pay $5.30 per share by 2026. They were paying a yield of 1.5% in 2012, but their stock price has been coming up so much that drives their dividend yield down to below 1%. And the forecast is for them to pay a 1.1% dividend by 2026. The CEO's salary is $1 million, total compensation $7.8 million. His tenure as CEO has been 2.1 years. There's been one insider sell in the past year, 15,000 shares. 65% of the company is held by institutions, 33% by the general public, and 1.5% by insiders. Vanguard is the biggest shareholder at 10%, 10 million shares valued at $5 billion. Their employee count was 32,000 in 2013. It peaked at 45,000 in 2019. It's down a little to 43,000 currently. The ticker trades in 6 places: the Nasdaq, Deutsche Börse, London Stock Exchange, Wiener Bourse, Mexican Bolsa, and Sao Paulo Bolsa. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.